Hi Andy.
Hi.
Thanks for giving us the time to discuss one of the most important topics in the energy sector, the future of the grid. As Nick has already outlined, National Grid has recently announced the near doubling of its capex program to 60 billion over the next 5 years. This investment plan has progressively higher spend across the period, with over 13 billion of capex in 2029, suggesting an even higher level of spend for the next 5-year period. Can you perhaps outline what are the key drivers of that higher spend?
Yeah, sure. Thanks, and good afternoon, everybody, and welcome to National Grid as well. Yeah, as we said, and Nick said in his intro, it's a really exciting time, and I think, when I look at those drivers, they are sort of similar but different across different parts of the group. And of the 60 billion, the biggest step up is here in the UK, where with 23 billion of that focused on our electricity transmission business. And when I think about the big drivers there, it's very much about effectively reconfiguring and extending the existing grid infrastructure, the existing transmission network in the UK, to accommodate the greater levels of renewables that will be required, the greater variability in the location and the direction of the flows on the network. And the important thing for us, of course, is that much of that is already embedded in our license. The ASTI projects, 17 major transmission projects, are already embedded in our license. We're up and running on delivery. There are, if I look across the rest of the group, of course, in the US, we've seen a 60% step up in our capex. And again, that's a mixture on the electricity side. Very similar drivers, actually. The greater penetration of renewables, the greater demand coming onto the network, and needing to ensure that the transmission and distribution grids are expanding and effectively renewing to stay up to speed with that. And then finally, you'll see with the gas business in the US, where we're continuing to deliver our Leak Prone Pipe program in particular, with gas remaining a critical part of the energy mix in the northeast, and continuing to be a big driver of spend. And we're seeing that again reflected in the latest rate case in downstate New York as well. Just to your point around, it will be a significant number, 13.5 billion by the end of the 5 years. I've had a lot of questions actually when I look forward. So what happens then? And the reality is, there are a number of different scenarios, and we will, I would absolutely expect to continue to see significant levels and drivers of investment. That doesn't necessarily mean that the increase is going to continue to be as rapid. If you think about the levels of spend that will be at, the affordability, I'm sure we'll talk about that at some point as well. I think there are definitely scenarios where we continue at a high level, but the rate of growth starts to soften, and so it's hard to get the crystal ball out at this point. What I can be assured of is that there will continue to be good drivers of investment.
Yeah. And what will be the key operational challenges in delivering that high level of investment? We already hear in Europe about constraints with HVDC manufacturing capacity. Sort of how tight is the supply chain or the availability of skilled labour, and how material is the deliverability risk of that investment need?
Yeah, it's absolutely one of our core focus areas over the last year or two, and I think both inside the company and of course with our supply chain, we've worked very hard to ensure that we are well placed, but we're definitely having to adapt and work in different ways with the supply chain. Inside the company, a year ago we stood up a new business unit, strategic infrastructure, to oversee the delivery of the ASTI projects, which is the big element of step up I referred to. We've already recruited over 500 people into that business unit. Some of those are internal moves, but many from outside as well. But of course, the critical thing, as you say, is the supply chain, and there we've looked at it in different aspects. So when we think about those projects, they're a mix of onshore transmission, but also importantly for us, subsea and offshore transmission. And therefore, as you said, offshore in particular, we are competing in a very tough global market, and we've taken two different approaches based on timing. So for the very early projects, we've looked to contract bilaterally, and we've had to be more agile in how we tender. We probably had less companies willing to bid, which is not surprising. And we've had to look at sort of tools such as upfront commitments, prepayments to ensure that we can secure that capacity. The important thing is that we have, and we've successfully secured that capacity. And then for the projects which are slightly further out, we've put in place framework arrangements where, because if there's one consistent message from the supply chain, it's about transparency and visibility of the commitment, the long-term commitments to volumes that allows them to make the investments that are required. And similarly, onshore, we've created a partnership, enterprise partnership, bringing in a number of different companies for everything from overhead lines, substations, civils, to all be part of that, where we share the risks and rewards of our regulatory arrangements through into the supply chain. And again, we look to give them the clarity of volumes that allows them to make the investments that are needed. And finally, I think your point about workforce, absolutely. We're very focused on how we bring in new talent, whether at the apprentice or the graduate level. And we're increasing the schemes that we run, and we've been very successful in attracting talent. But importantly, we've also focused on training. Today, it takes more than 3 years to train an overhead linesman. And when you think about the pace of the ramp up and the demand for labour, we're working very closely with the supply chain on how do we get that down sub 12 months? How do we approach training and development in a different way to allow us to get people into the organisations and up to speed much more quickly? So those are the types of things we've had to do to address some of those challenges.
And the increased investment obviously needs to be funded. You've recently completed a 7 billion rights issue, the largest in the UK since 2009. How much capacity has that given you in terms of funding that investment, and what other balance sheet measures are under consideration?
Yeah, and firstly, I've seen a few folks in this room who represent funds that have supported us. So thank you for those who have invested in the rights issue. I think the important thing for us when we announced that is about giving long-term clarity. So one of the important messages we said when we announced the raise was, this is about giving us certainty of funding through to 2031, the end of the next regulatory period. So yes, of course, not surprisingly, the focus was on the £7 billion equity raise, but we positioned it as part of a broader funding package, including the action we took on the dividend, including continued issuance or use of the scrip option. Obviously, significant continued access to the debt markets over the next few years, the crystallisation of some value through a couple of asset sales that we announced. And in the longer term, continued use of the hybrid markets as well. So all of that, is about giving confidence that we will navigate the balance sheet through this period of much higher growth to ensure that we retain the credit metrics that we need against the thresholds, plus obviously the appropriate buffers that we'll always look to retain. So it was very clear, having done that and executed the raise successfully, that's put the balance sheet in an absolutely robust position to navigate us through, as I say, to at least 2031.
You mentioned the use of the scrip dividend. In the US, utilities seem to have more regular periodic equity issuance, particularly through their at-the-money equity programs. Do you think it's easier in the US because investors are more accepting of periodic equity issuance, or do you think the sort of one-shot, sort of clear the table approach is more beneficial?
Yeah, and as you can imagine, I've had a number of conversations along that train over the last few weeks. But I think what I'd start with is as a board, we thought very hard about all the different options in terms of, how do we finance this unprecedented level of growth. And we considered everything from and including sort of portfolio changes, as you say, different types of equity raise, different approaches to the dividend. We believe that ultimately the package that we came up with was the right balance of utilisation of all of those tools. Specifically around the approach to raising equity. It's fair to say when I've looked at some of my peers in the US who have that ability to use what's called an ATM type approach, you can see absolutely some benefits of that. But I think that's a broader question for the markets, for us, particularly with preemption rights. We believe that the right approach was to give our existing investors the opportunity to take part in what we absolutely believe is valuable growth, and therefore the discounted rights issue approach allows them to do that. And what actually, as we've seen, we've had a very strong level of take up and support from our existing investors in that raise. So, we believe that was the right approach, and we're very pleased with how it's gone.
Yeah, no, that's good. And is the regulatory framework supportive of the structurally higher level of spend and equity issuance environment that we will have across the sector going forward? It appears that the ASTI program sort of has recognised the benefit of bringing on the projects early. So we seem to have seen improvement there. But in an environment of global competition for capital, do you think Ofgem's new investibility framework will actually deliver sort of the required changes?
Yeah, I think let's start. What we've seen with Ofgem over the last probably couple of years actually is a real positive progression, and credit to Ofgem for how they've responded to the changed expectations, the accelerated demand in terms of delivery. And I think you mentioned ASTI, and I think that's a great example of we've gone from 2 years ago where these projects were first incepted, first sort of created in terms of a list and an expectation of delivery. Within a year, we had them in our license, and another year on, we're into delivery. We're getting the first set of projects through regulatory approvals with Ofgem. We're working very closely with the regulator around the approach to the supply chain. Some of the things I mentioned earlier, which are relatively novel in this space, the regulator is working closely with us, ensuring that spend is effectively going straight into our asset base and allowing us to earn a return up front as well. So I'm very pleased with how we've been able to work with Ofgem to create that framework. As you say, obviously we are still in what is quite a long process to get to the detailed financial outcomes, including of course the returns. But some things we've seen from them again are very much moving in the direction we want to see. They themselves obviously now have a couple of new statutory duties, which broadens out their long-term focus on customer protection, to take into account a demand that they support the delivery of growth and of course the delivery of net zero. And I think that itself is a very important balance for them to think about. I think we've seen them reflect that into their strategic priorities, and most recently, of course, into their sector-specific methodology consultation, where, as you said, they introduced this phrase, investibility. And I think we've been very clear in our response where we would like to see focus when we move to the decision, which is the next step. And as a reminder, it's a process that runs for another 18 months yet to the end of 2025. But we would really want to see the progress we've made on ASTI reflected across the rest of the regulatory framework. So the agile, accelerated approach, forward-looking, how can we embed that across the rest of our spend? We think there needs to be a greater focus on incentivization. I think RIIO-2 probably took a bit of a step back, and I think there's an opportunity, recognizing ultimately that incentivization is in the long run beneficial to consumers, and therefore we think it's something that they should look further at again. Making sure that they are forward-thinking, and the supply chain question you asked earlier, making sure that they're reflecting the supply chain challenges in their approach to setting unit cost allowances. And of course, finally, and as importantly, the financial framework itself, recognizing that, and we're a great example, we have opportunities for investment in the US and in the UK, obviously different regulatory frameworks, different allowed rates of return. And that's absolutely something that we will continue to have the dialogue with Ofgem on. But it's important that for us, it's not just about the return. It's always been about the overall financing package, the speed of cash, to ensure that we're delivering a cash return on these investments as we go through the strong investment cycle. So that's just a subset of the things we'll be looking for. But definitely, we're pleased with the progress. We're pleased with the dialogue, and obviously slightly delayed because of the election, but looking forward to SSMD for the next step.
Yeah. And having raised the equity to fund the higher level of expected investment, is there a risk that potentially the projects get delayed, or potentially the projects get opened up to competition, and therefore sort of your expected level of investment isn't necessarily as high as currently anticipated?
Yeah, I mean, just firstly on the competition point, just to be clear where we are. So Ofgem, post the Energy Act that was passed last autumn, does now have the legislative right to put projects out to competition. However, as I mentioned, the wave of projects that are driving the big step up in the next 5 years, the ASTI projects, they are all in our license. So it is, they are not going to be competed. They are effectively already embedded in our regulatory obligation. Absolutely, as we think about future waves beyond 2030, we can certainly see options where they may look to compete one, two, or a few projects, and we wouldn't be surprised to see that happen. We're very confident that if that happens, we're well placed as a company to be able to take part and compete successfully. And I think we'd back ourselves to do well. So I don't see sort of in this 5 years competition as a threat or even as a sort of distraction from the investment that needs to get done. And I think more broadly, when go right back to the start and the need for this investment and the recognition that certainly for the next period of time, the pace of investment is as critical as the marginal cost of that investment. And I think that will be reflected in how all regulators think about costs and benefits, and how that drives their thinking about what's the best route to get this done, incumbents versus competition, and so forth. In terms of more broadly your question around delivery, I think we're very clear that the 60 billion is our best view today, and around 70+% of that is already either in our rate cases or price controls, or very close to being agreed as part of ones that are underway at the moment. We've mentioned supply chain, one of the big focus areas. Of course, the other piece is planning and consenting, which I'm sure many people in this room are familiar is a challenge for all infrastructure developers. But we have taken again what we believe is a practical and conservative approach to planning assumptions across those projects. Ultimately, we in the UK we have the ability to take projects to the Secretary of State for DCO, and that's a tried and tested path, and we've successfully used it. And similar, slightly different, but similar paths apply in our US jurisdictions as well. And so we're confident that with the regime we have, we can absolutely progress these projects. Of course, certain things will slow down, things will slip 1 year to another, but also things will get accelerated as well. So overall, we're very confident that the 60 billion is a good number for the next 5 years.
And if I look at your investment plan, 85% of the capex is taxonomy aligned. You still have a sizable US gas distribution business. It could have been potentially a disposal candidate when you were looking at funding options. Sort of broadly speaking, sort of what are the differing characteristics of sort of an electricity network versus a gas network business? And longer term, could there be a benefit of moving towards a pure power play structure?
I think whenever we look at the assets within the National Grid portfolio, we are always looking for that balance of growth and yield. And ultimately, growth today is going to deliver tomorrow's yield. And over the years, I think we've shown, probably most recently here in over the last few years in UK gas, both with the Cadent disposal and then most recently with the gas transmission disposal, where we've seen a business that we're potentially moving towards lower growth rates, and that we absolutely will take action on that. And we've successfully navigated the portfolio, and of course adding UK electricity distribution to the portfolio as well. When we look at US gas, we still see that in a very different light. It is a business which is still growing strongly. I think high single digits. I mentioned right at the start the driver coming from the leak-prone pipe program that has many years to run, and is strongly supported by our regulators. The most recent rate case in New York in Kedney Kedley we're seeing a step up in the demand from the regulator to go faster on that program. And we're seeing a step up in capex in New York as a result. We're seeing good support for returns, with the step up around from 8.8% allowed return for the old case to 9.25% in the new case. And all of that leading to strong cash characteristics for that business as well, being very supportive for credit metrics. So when we assess that business, as I said earlier, in terms of thinking about all the different options for financing the growth, we believe that business contributes very well to the proposition, continues to be very supported by regulators, and we believe it's a valuable part of the group going forward.
And similarly, sort of what are the regional differences of sort of the US business compared to the UK business, and what are the benefits of having a multinational group?
Yeah, and again, for those less familiar, we sort of having started in the UK, we started adding to US acquisitions around the turn of the century, and have gradually grown the US business over the last 20 years or so. And today we're around sort of 45% US, 55 UK. There's no target that we set ourselves, but to your point, we absolutely value having that spread across the jurisdictions. And of course, there's a diversification point there. If you think about the scale of National Grid, the size of the business, having all of that within one market, one regulatory jurisdiction, we believe there's absolutely value in diversifying that regulatory exposure. But importantly as well, and speaking to the CFO, having the mix of nominal and real regulation is powerful for us as well. Nominal regulation means that you get your cash slightly faster. Real regulation, ultimately you can achieve broadly the same achieved return once you allow for the inflation protection in the UK. But more of that return is deferred into the asset base. So you're creating greater asset growth, you're creating greater debt capacity, but you're getting your cash back slightly slower. And that, when I think about the overall TSR proposition of National Grid, that blend and that combination has been very powerful for us. And it's certainly one of the strengths we see going forward as well. So, there's absolutely an economic benefit we see to having that breadth as well.
And finally, we have a general election in the UK tomorrow. Earlier than expected. And we have a presidential election in the US later in the year. We're still awaiting to see whether it will be Biden as the Democrat nominee. But what changes do you think could potentially come about, and what policy developments would you like to see from governments coming through?
Firstly, I could probably, given polls, I'm probably more able to suspect what the UK election outcome is going to be. Probably less willing to try and call the US election in a few months' time. I think, in terms of the UK, what I'd say is we've spent a lot of time working with the Labour Party, understanding what their priorities are, working to try and sort of also educate them on some of the practical issues that are faced in terms of meeting their own sort of ambitions. But, because overall they're very aligned as political parties in terms of the overall direction of travel. And I think that's one of the things that gave us absolutely the confidence to go forward with setting out our 5-year plan. They want to, in some areas, to go even faster than the current government. They're talking about wanting to decarbonise the power system by 2030 versus the existing government has a 2035 ambition. And they sort of recognise that is challenging, but which is why they've also talked about things sort of tackling some of the planning and consenting mechanisms, wanting to ensure and understand how they can support the private sector in delivering that as well. So that takes you on to sort of GB Energy. Again, I'm sure people have heard about GB Energy that the Labour Party has created. Firstly, I think that's, everything they've said is that's very focused on generation, renewables, potentially new nascent technologies. It's not focused, from everything that we've seen and been told, on transmission. But I think that there is an opportunity for government, or for the Labour Party, if they came into government, to potentially look at, is there a convening role that they can play? Back to supply chain. If the government or working with the regulators could create a framework that allows us to make longer term commitments, that would allow us, like some other countries are able to do, to place orders and make commitments to the supply, firm commitments to the supply chain over a much longer period of time. So absolutely, that's one of the things that I think we'd like to continue to work with the incoming government on. Planning and consenting is, again, as I mentioned, they've said that that's an area they want to focus on. Again, we work very closely with the Conservative government on how we could see that being adapted and changed to speed up the regime in the UK. Again, I think if we are going to move successfully towards 2030, it's not me committing to hit it, but recognising that move faster in that direction, we absolutely have to tackle planning and consenting. And so that is something I think that would be a priority for any incoming government. In terms of the US, I think it's a bit early to tell. I think there's been a lot of focus on if President Trump was re-elected, would he go after the IRA or the IIJA? My sense is it's a bit more nuanced than that. I think under both of those, there's been successful routing of funds into Republican states as much as Democrat ones, and I think you might see sort of potential changes in maybe where the money is directed, how it's spent, but I think it's probably more nuanced than is the scheme going to be stopped or blocked. So I think we'll have to wait until a bit nearer the time to see where that's going to go.
And I think with all of these elements, I think stability from an investor and corporate point of view is highly valued.
Yeah, absolutely. I think, and that's why back to the dialogue we've been having in the UK and the overall the direction of travel is very clear. They want to push towards electrifying and decarbonising the energy sector. Our 5-year programme is very much about enabling that. And we think it puts us in a very, very positive position with any incoming government that we're now extremely well placed for National Grid to play its part in delivering that.
Well, thank you. Thank you, Andy. That was very encouraging. It's a good overview. I think we've got the opportunity to take some questions. I can see Harry with his hand up.
Thanks. I'll reprise my role as the sell-side analyst here. I wonder, how are you thinking about the share of the electricity bill that's coming from networks, which I guess the historical answer to this question was, don't worry, because it's very low. And even if we have a significant increase in our revenues, it's got a limited impact on the consumer bill. But as time goes on, the argument will probably weaken a little as networks become a higher share of the bill. So how do you manage that risk looking forward, especially if you had another gas price shock for any reason and energy prices became a big political issue? And whilst in the past networks haven't been cast as a villain in that debate, perhaps in a future period when network costs are higher, they might be. And also from a political standpoint, how ready would, if we assume it's the Labour Party, how ready would they be to sort of understand the necessity of networks and their role in delivering the energy transition and perhaps to kind of defend you from any pressure that there is to reduce the burden of networks on the consumer bill?
Yeah, thanks. I mean, on the first one, and as a reminder, that if you take the latest energy price cap that's just come into force, around £1,600 for the UK average bill, dual fuel. So today, transmission is between £20 and £25 of that. Electric distribution is around £100 of that, just to give you a sort of a sense. And I think the important thing is, yes, no doubt that these levels of investment are going to add a few pounds to that. Precisely how much comes back to the regulatory framework and what's the pace of cash and allowances and so forth. But there's no doubt it will go up slightly. But the reality is, and this is, I think, one of the things that both in the political arena and also the regulatory thinking has become very much aligned over the last couple of years is, ultimately, if you want to get to a place where you can more sustainably hold bills at a more sensible level going forward, delivering this network reinforcement, allowing the renewables to come on more a greater penetration, removing or reducing your reliance on imported fossil fuel and therefore your attachment to the international price of gas, ultimately is a more sustainable way of managing bills. And I think if you look at some of the actions that Ofgem have taken, that's reflected in the way they're thinking about their cost-benefit analysis. A few marginal pounds on the transmission bill today potentially gives the ability to avoid significant increases or bring down the commodity but also the constraint element of the bill going forward, which are vastly in excess of the 20 to 25 pounds that is transmission today. Of course, headline is you're still putting a few pounds on the bill, but that's sort of the broader picture and why we believe that even with a change of government, I think that recognition that it's important to get this transmission investment done, because it's the only way to unlock those renewables onto the system, the only way to remove some of those constraints. And just the finer point around education, I think, as I said, we've worked very hard with the Labour Party, Ed Miliband, who's led on the energy brief for a long period of time. He knows the sector very well. He understands, and his team, I think, understand well the importance of transmission. And just like we've been talked about by the Prime Minister and the Chancellor of the Exchequer in the past, over the last 12 months or so, the leader of the Labour Party has talked about networks and the importance of grid connections as well. So I think we remain pretty confident that they're going to continue to support the delivery of the investment that's needed.
I see we've got Mark.
Hey, hello, thanks for taking my question. If I look at the challenges in transmission and to a degree distribution, many infrastructure sectors have these more capex or more totex. If I look at water, some of the big road schemes, I look at fibre, which is big as well, and you add up all of the industry's capex plans, sure, there's unit cost inflation in there, but there's also an immense amount of resource that just isn't there, right? And we're hearing reports from former businesses that you owned, they just can't get semi-skilled labour to do some of the work, and they're looking in places they would not previously have gone, and they just can't find it. So what is it that gives you confidence that your 60 billion, which is 70% committed, can be done, and the contractors, because most of it's done by contractors, right? How is it that you're sure that your 60 billion gets done and it's somebody else who can't find the labour, or labour comes from somewhere else? Because you see the issue, the sum of the parts doesn't really equal the sum of the whole.
No, and I think, as I said earlier, it's not easy, just to be clear, and I can't comment on what other companies may or may not have said. But all I can give you is what we're doing and what we're seeing, and we are, as I say, both internally, where we are attracting the intake that we need today, and we can absolutely see, given the numbers that are applying, that it is at an attractive place for people to come. As I said, we need to tackle the training so we can get them sort of up and running more quickly, in terms of cutting the amount of time that before they can become productive. But overall, we are absolutely seeing, so from a direct company perspective, we're seeing that. In terms of the supply chain, I think, all I can do is say we are successfully contracting. They are committing, they are signing up. Yes, it is hard. Yes, we are seeing unit price increases, but we are being very clear that those are being effectively done transparently with the regulator as well, to ensure that our allowances reflect those higher unit costs as well as the higher volumes. And as I said, I think that the one thing they're wanting is the long-term clarity, and that transparency of volumes, so that they can make the necessary investments to create that capacity that you're saying is needed. I'd agree. If you look out to the end of the decade, the HVDC cable market is pretty maxed out, and therefore, if you're looking at projects, at the back end or certainly into the 30s, you are looking at a need to create more capacity. What we're hearing consistently from the supply chain is they're willing to do that, but they want those long-term volume signals so that they can invest against that themselves. And that goes back to the point I made earlier about, I think, how we can continue to work with Ofgem, with an incoming government, to create a framework that allows them to create the environment where we can make those longer-term commitments without, today that would be an exposure for us as a company, because we wouldn't have the regulatory underpin. I think importantly, we would want to try and get to a place where we do have that regulatory support. But no, you're right, Mark. It's a tough environment, but all I can do is share with you the success we're having. But we're having to work very hard to get there.
And hopefully that results in not just more capacity, but more British capacity potentially. With the Sumitomo plant that SSE is contracted with.
Yeah. Agreed.
Well, great. Well, thank you. I will draw this session to a close.
Okay.
Pass them through.
Thank you.
Thank you. Thanks, Andy.